Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. Today was a very interesting day because on the last trading day of the week the market sold off almost 300 points, and for a good part of the day the Dow was down over 300 points on negative news of the world indices getting hit around the globe. So of course last week we more or less forecasted that. On this particular day right here, that was Friday of last week. I'll zoom in here for you so you can see that a little bit more clearly. On Friday, I put out an alert that we would go up and test this upper resistance line, which we did. Monday, Tuesday, Wednesday, Thursday. Wednesday and Thursday we touched above that, but still held the highs from back here on March 23rd. So our forecast came true, which is what happens almost 90% of the time. And what I said last week is that we would test this resistance and eventually come back down to test support, which is right around the 175 to 176 area for the diamonds, which would be 17,500 to 17,600 on the Dow. The only thing that really gets in the way of us completely breaking down below the support line is that today, the 17th, we literally gapped down on the Dow. So now we have a gap above the market and we have a gap below the market. So the price action is caught between two gaps. What I think could happen is that we could rally up a little bit to fill this gap earlier next week, but eventually having this resistance line hold, and then we'll turn lower from there. So I think ultimately my safest guess would be to put a line projecting a downward move out a little bit further, because we have to give this a couple of days to trade earlier next week. The other interesting point is that today's red candle, although it's a large one, we had a little bit of a shadow underneath that candle, and it was on much higher volume than earlier in the week. So we're kind of caught between two gaps, like I said before, and we're caught between support and resistance. So that's the Dow. I still wouldn't take any aggressive long positions. I would be in a very protective stance right now because we are still seeing lower highs. We had lower lows, but if this low breaks, remember what I said, then that's something we need to all be concerned about if you are currently long the market. Now if we take a look at the S&P 500 through the Spiders ETF, you'll see same thing applied from last week, where this horizontal line was the timeline that I drew marking the 7.5 year cycle. I can go to the monthly chart to show you what that looks like. So I'm going to leave this projection of the future trend, where I think it's going to go, I'm going to leave that on the chart, because that's the monthly chart that we're looking at there. And you'll see that when I go to the daily chart, that line more or less still holds right there. So today we gapped down on the S&P as well on higher volume. The Russell 2000, that's the more broad-based index, that gapped down as well with a series of gaps below the market. So we're seeing this gapping, which is really a sign of higher volatility. Gaps are not normally what you see on the major indices. You'll usually see them on individual stocks as news is released. But when you have such a broad-based index like the Russell 2000 and even the Spiders, which is of course not as broad-based as the Russell 2000, it's measuring still 500 stocks, you see that there's a lot of action going on. If you look at the Qs, that's the NASDAQ market, represented in the power shares, ticker symbol QQQ. This too gapped down, but the resistance line held. Again, this is what I pointed out last week, where we have lower highs, and today's down day was on higher volume, so it's going to probably stay in this area right here between support and resistance. What we have to watch is that the resistance is starting to converge in on support. We have more or less a flag pattern or even a triangle pattern starting to form. As this trading range narrows and it starts looking more like this, then you'll start to see a pinching effect where eventually the market will break up or break down below a key support level, and we could see something like that happen eventually in the market. So I think this area within here, a converging channel, if you will, you could look at it that way. This is all trading opportunity for us. I still love the option markets because there's so much you can do. If you're an equity trader and you have not yet dabbled into the option markets, then I would encourage you to at least look at the Market Guys website and learn a little bit about options so that you can dip your toe into the option pool, so to speak, and at least get more familiar, because there are some very conservative strategies that you can put on. And then, of course, there's the advanced ones, but you don't have to jump right to the advanced levels. You could start really basic and learning how to buy a put or buy a call, and using them as trading instruments, you could really leverage your money without risking too much more than what you're already risking. Now, finally, if you take a look at the VIX, it's ticker symbol VIX, I did forecast a pivot point. This is the line that I drew representing a projected trend or a short-term leg here, and lo and behold, what happened is we did see that pivot point actually form today as we had a higher high and we had a higher low from yesterday as well. Remember, the VIX is inversely related to the S&P, so as the VIX becomes more bullish, or as the VIX starts to rally, the S&P will move opposite to that. So a bullish VIX is bearish for the indices. Keep that in mind. So this is a very, very important leading indicator that you should put on your watch list. And listen, if you have volume as a leading indicator and the VIX is a leading indicator, then your percentage of accuracy is going to increase because you're stacking the probability in your favor of making money. And that's the whole mission of the Market Guys, is to offer financial education that will allow people to call the markets and do it with great accuracy. Now, speaking of education, on Monday, that's April 20th, at 8 p.m., we have an open house session. That is open to you, and you could submit questions. You could give me your stock symbols, and we'll analyze those stocks. And if you just want to be a fly on the wall and just watch what's going on, get a pen and paper ready, because the stock symbols that are submitted by the audience are many times great stock trade candidates. So you can get some new ideas and get some of your questions answered even without you having to ask the question. There's usually someone in the audience that will ask something that you might even be curious about. So in order to register for that event, just go to the Market Guys website. That's www.themarketguys.com. Scroll down, and right there you'll see the registration link. It says please register for open house. There you go. You click on that link right below that, and it brings you to the registration page. From there, all you have to do is fill in a couple of the blanks, and you click on the register button, which is underneath, and then you are good as gold. Your seat is registered. What's great about our system is that it'll send you a reminder email so that you won't forget to log into the session. It's very exciting. It's a 1-hour free event, and it's something that I build up to each and every month, so you don't want to miss that. So have a great weekend, and we'll speak with you on Monday. So long.